Hi guys, today's video will be about will be an introduction into inventory control systems. Okay, so we're going to start off with the perpetual inventory control method. So the objective today is to define the perpetual inventory control method and also to outline the journal entries in record keeping for the perpetual control method. Okay, so the perpetual inventory control method. It's a method that involves continuous record keeping of inflows and outflows for inventory with every single transaction. So it should provide an updated balance for inventory as well as COGS. So theoretically, if all inflows and outflows are recorded, the ending book value of inventory should equal opening inventory plus purchases, which are our inflows of inventory, minus outflows, which are our sales as a result of COGS. Okay, so that should give us, this is outflows and sales, this should give us the book value of inventory, or what inventory or final inventory should be, the value of it. Okay, however, so much like bank reconciliations, sometimes the records will not match a physical count for closing entry, and there is usually an amount. The amount is usually less than anticipated, or less than what we expect in the books in a perfect world, and that can be a result of theft or loss of inventory. Okay, so any shortages that are recorded as an expense. So it's called an inventory shortage expense, and that is an adjusting entry that we provide at the end of each financial period, and then we credit inventory so that we have an amount in our inventory that measures how much is physically on hand. Okay, so I'm just going to give you an example of how we do that. So for example, SC Ltd had an opening balance of inventory worth $1,000. The organization made total purchases of $20,000 for the year, sorry, and incurred $15,000 of COGS, with a final inventory count for the year was worth $3,000. So what do? Right in the beginning, we recognize our purchases, so that's $20,000 worth. So we debit inventory, we increase that by $20,000, okay, and then we credit accounts payable by $20,000 because now we owe our suppliers $20,000 because they've given us that inventory. Next, we recognize sales during the year and as well as COGS, and that's a part of our matching principle. So therefore, we start recognizing sales. Okay, so let's assume, so we'll normally debit any cash or receivable of, let's see, for example, we sold at $50,000, and then we credit sales revenue for that sales amount, for example, of $50,000. Okay, so we have to make sure that this amount is actually the sale amount that we made and not the cost. The cost is actually related to our COGS. So we debit COGS of $15,000, and that's the value that we paid for the inventory that we later sold for an upped price, and that is our sales price. Okay, so we need to get those separated, and then we have to credit inventory of that $15,000 because now we've lost $15,000 worth of inventory. Okay, so then afterwards, after that final count, so we'll just use the formula first. We'll use the formula to work out any shortages. We're going to start off with the ending inventory of books, so what that should equal. So the opening balance of inventory was $1,000. Then we plus purchases of $20,000 minus $15,000 COGS. So we should, in a perfect world, with no losses, no shortages and things like that, we should get an ending book value of inventory of $6,000. However, we're told in the question that this year we've only found $3,000 worth of inventory. So as a result, so book value would equal the minus shortage expense. So book value minus shortage expense should equal the physical amount, which is $3,000. So if we calculate this correctly, 600 minus 6,000 minus x equals to 3,000. Therefore, x should equal to 3,000, and that will be our shortage expense. So we debit invent shortage expense by 3,000, and we also credit inventory by 3,000 in order to reduce the book value of inventory to what the physical amount is. And then lastly, for our if we go to step 7 of our closing entries, this is what it would look like. So if we close off the temporary accounts as usual, so we'd have to debit our sales, remember, 50,000, and we credit P&L summary 50,000. Okay, now we should start off with the credit side here. So we credit COGS 15,000 in order to make the COGS account 0, because before it's a debit COGS. And then we also credit our inventory shortage expense of 3,000 to make that account 0, because before it was a debit of inventory shortage by 3,000. So if we credit by the same amount, the amount is 0, the balance is 0. So then we close it off, and then we put that all to P&L summary of $18,000. So the debit should equal credit. Alright, and then afterwards we move, so we transfer any excess from the P&L summary. So we would do 50,000 minus 18,000. That equals to $32,000, and it would be obviously be in credit. So because that's a credit, that's a debit. This credit is higher than this debit, so therefore there's still that much of a credit left. So in order to bring this P&L summary to 0, we have to debit it by 32,000. So we debit P&L summary 32,000, and then we credit retained profit 32,000. Okay, so that's how we're going to do that's how the inventory, or the perpetual inventory control system works. I hope you learned something today, guys. Thank you.
Cut study time with concise video summaries by top students. Visit spoonfeedme.com to view more free videos in this course and hundreds of others.